Hello everybody and welcome to episode 4 of TipToeHippo's podcast, Hippos at the Waterhole. This week I want to talk about portfolio management and how we can get a whole series of systems put together and drastically reduce the overall risk that our account will be taking. So to begin with, I'll introduce to you the concept, and it's not my concept, it's from Ray Dalio, and he is a well-known hedge fund, I guess you'd say titan, and he has a rather simple method of creating a portfolio, which, because it's so simple, we all should pay attention and apply to our own trading strategies or groups of trading strategies that I guess we call a portfolio. So to begin with, let's just introduce the general idea of risks and returns. So the fundamental premise of investing lies in committing capital to various ventures or assets with the expectation of generating a profitable return over time. And so when we talk about assets, we're broadly referring to anything that holds potential for financial gain. So it could range from tangible entities like the real estate through to intangible ones like stocks, bonds, or in our case, the application of a trading strategy. However, as we all know, the prospect of returns does not come without risk. Every investment, be it real estate, property, or stock, or our trading strategies, carries with it some level of uncertainty. And the crux of the matter is this: the potential for higher returns is intertwined with the higher risk. So in this context, the risk represents the potential for your investment to yield less than expected or even result in a loss. So for example, a stock price may decrease instead of increase, or a trading strategy that was successful in back testing may not perform that well in real market conditions. And so this brings us to the fundamental goal of investing: to maximize the returns that we can get while simultaneously minimizing the risk. Now, as investors and traders, our task is to balance these two opposing forces, the returns versus the risks. We want to reach for the highest possible return, but while controlling our risk and not taking on any more risk than necessary. So today we'll explore how diversification across different low correlated trading strategies can help us achieve this crucial balance. This approach aligns closely with the principles outlined by renowned investor Ray Dalio, and he talks about his concept of the Holy Grail of Investing, which is what we are going to be looking at in more detail today. So firstly, we want to understand diversification. So the key in managing the inherent risk-return trade-off we were talking about lies in the concept of diversification. And when we talk about diversification in the context of how we thinking about it, our trading approach, we don't mean it in the traditional sense of investing in a variety of different asset classes like stocks, bonds, real estates. Instead, our interpretation of diversification focuses on the application of trading strategies and using a multitude of trading strategies as diversification. So what we want to do is spread our investment or our trading across a variety of low correlated strategies. This strategic allocation will help us reduce the risk overall associated with our trading strategies, and the technique will aim to maximize returns by investing in different strategies that would each react differently to the same market event. And the logic behind his diversification is pretty straightforward but powerful. Different trading strategies will react differently to various market conditions. A specific market condition might cause one strategy to underperform. However, in that same market conditions, another strategy may thrive, generating positive returns. And then this dynamic can balance out the underperformance of the first strategy with the overperformance of the second strategy, resulting in a stable overall portfolio performance. Now, we get on to Ray Dalio's Holy Grail of Investing. Now, in the realm of finance and investing, few names are as respected and influential as Ray Dalio. He's the founder of Bridgewater Associates, which is one of the world's largest hedge funds, and Dalio is widely acknowledged for insightful views on investing and economic principles. One of his most significant contributions to investment theory is the concept that he has labeled the Holy Grail of Investing. Now, Dalio's Holy Grail of Investing hinges on the principle of diversification, much like our own trading methodology. Dalio offers specific guidance for this diversification. According to him, to obtain optimal balance between risk and returns, an investor should diversify across 15 to 20 uncorrelated revenue streams. And he does this, or he displays this via a graph, which I will bring up now. Dalio displays his idea in the following graph. Now, if you're listening to us on the podcast, you'll be able to find this graph in our blog section or on our YouTube. But effectively, you should be able to get an idea of this in your brain, and as I talk through it, I will give out the general concepts and we'll pick up on them no matter if you're listening to this in your car or you're watching it on YouTube. And so the graph that we're displaying has the annual portfolio standard deviation on the y-axis. So the left-hand side axis is a representation of the performance to the risk of the portfolio, and across the bottom it has the number of assets in a portfolio, and then it has 5 different lines that start at the top left of the graph, and depending on the different correlation, they then drop down to the lower right. And we see on the graph that a 0% correlation between the strategies has a much bigger effect on the reward to risk ratio than a high correlation does. So a high correlation benefits far less from the number of strategies than a 0% correlation. Now, of course, in selecting trading strategies, we're not going to be able to get zero correlation across all the strategies. We hope to get, when we trade, about a 20% correlation value across our different strategies. And so on the graph, that's the midpoint roughly of the different correlation settings. But what is interesting is how the graph drops down early on in this section here. And so very quickly, the standard deviation or the return to risk improves as we get out from 2 to 4 different low correlated strategies. And then the further out we go, the less marginal benefit we get from each additional strategies. So by the time we get to about 10 strategies, we've gotten most of the benefit from diversification. It still continues to improve as we go out towards 20, but each time we add another system in our portfolio, the benefit of that particular strategy drops. So what we find is we want between 10 and 20 strategies in our portfolio, and that then will maximize the benefit of the portfolio while also not becoming over burdening on the amount of strategies that we need to find. And so in the context of our trading approach, we're ensuring that we have a wide variety of strategies in our portfolio. So by having a wide variety at the lowest possible margin, lowest possible correlation between the strategies, we can reduce the overall risk of our portfolio while not diminishing our expected returns. So the beauty of this approach is that if a particular strategy underperforms because of a specific market condition, if we've calculated the correlation correctly, the performance of the portfolio as a whole should remain robust due to the offsetting performances of the other strategies. So by harnessing the power of diversification in the manner that Dalios suggests, which is a really simple one, 10 to 20 low correlated strategies in which we can use SQX to filter them out into what our maximum correlation between strategies are, we can then navigate the precarious path of trading and tame the inherent risks that are involved while capitalizing on the potential for profit that it contains. Now, this idea of many low correlated strategies is at the core of TipToeHippo's philosophy and our trading strategy. And so going back to Ray Dalio, his investment psychology underscores the pivotal but underappreciated aspect of portfolio management: the primacy of strategic allocation over individual strategy selection. So this concept might seem counterintuitive, especially in our field where so much emphasis is often placed on picking the right strategy or the best strategy or the Holy Grail strategy, or, as you might think, trying to find the needle in the haystack or the gold coin in amongst all the rubble. The traditional approach focuses primarily on the individual components, attempting to pick winning strategies and avoid underperformance. However, Dalio shows that the power of the portfolio lies not in the individual performance of each strategy, but in when they're all low correlated, they end up in harmonious interplay because of the diversity of the investments and their low correlation. So this perspective is a paradigm shift that you need to make as portfolio creators, directing attention towards the correlation between the strategies rather than selecting your systems based purely on their own individual merits. So this approach also aligns with modern portfolio theory, which contends that in investments, inherent risk and return characteristics should not be viewed alone, but evaluated by how the investment affects the overall portfolio's risk and return. We can go into the maths here, but that's why Dalio's explanation and that graph that, if you're watching on YouTube or you've looked at the blog, you'll see is very simple in its way that it displays the idea of 10 to 20 low correlated systems will give you the best return while minimizing your risks. So that's the key takeaway from today's podcast, is that diversifying across a wide array of low correlated trading strategies. So by low correlated, it could be a totally different method of trading the same instrument, or it could be trading in the same manner across different instruments that don't move together in correlation, and therefore their results aren't correlated. And if we can pick strategies that are low correlated, we can reduce our overall portfolio risk without sacrificing the expected return. So effectively, if we can navigate the risk return trade-off correctly, we can get what Dalio calls the Holy Grail of Investing. And we take this as the crucial part of the trading philosophy. We can create systems. Then after we create the systems, we want to test them to make sure that they're finding actual edges in the market and there aren't just lucky coincidences that have caused them profit. Then we can collect a whole pool of these robust systems and look how we can combine them to get the lowest cross-correlation between them all. And so this concept that Dalio comes up with isn't just pie in the sky. It's rooted in empirical evidence. It has robust theoretical frameworks. And so it's statistically proven. And if you're being a serious trader, the idea of having a portfolio of 10 to 20 independently correlated trading systems is, as Dalio says, the Holy Grail. Uncorrelated streams. So the idea is, again, that we want ones that don't move in sync with each other. Now, how do we do that? We look at their performance. So we want to look at both the positive and the negative performance of the strategies. And if they're lowly correlated, then it means then if one strategy makes profit, then another strategy mightn't make profit at the same time. But more importantly as well, that it doesn't lose money at the same time. Now, this lack of correlation between two different systems, that means that when one strategy underperforms, it doesn't necessarily result in underperformance of the other strategies in the portfolio because they're all not correlated very highly together. So the value of uncorrelated systems becomes evident when we view the portfolio as a complex ecosystem with interplays within the market, rather than a collection of individual parts. It's just like biodiversity contributes to the overall stability of an ecosystem by reducing the dependency on a single species. The presence of an uncorrelated set of systems in a portfolio contributes to the overall stability and resistance of that portfolio as a whole. So what we want to do is reduce the risk that our portfolio's performance is overly dependent on a single strategy, either the dependence on it being profitable or the dependence on it being unprofitable. So if one strategy experiences a downturn, the impact of the portfolio is cushioned by other strategies that remain ineffective or perhaps even thrive under the same market conditions if they're low correlated. And this dynamicism enhances the stability of the portfolio's performance across all different markets and make it more resilient in the face of any future market that it will see. And it ensures that the portfolio doesn't rely excessively on any single market or any single type of market. Because the strategies are low correlated, they're likely then to perform better in different markets. So it makes it well equipped to navigate the future, which is what we're always insisting is the primary crux, be it through robustness checking and also through this idea of portfolio creation. So the uncorrelated systems play a pivotal approach to how we trade, how we build our systems, how we select our systems, and in essence, it's following Dalio's Holy Grail of Investing. So as we journey through the principles of investing and we look at portfolio diversification, the common thread weaved throughout this podcast is the power of diversification across uncorrelated trading strategies derived from Ray Dalio's Holy Grail of Investing. And this should underscore your trading philosophy and your portfolio selection and strategy. In essence, if you can allocate your account across various different low correlated strategies, you will increase even again your robustness of your trading systems. It will allow you to harness the dynamics of different strategies and their reactions to different market conditions. And then we can minimize our portfolio's risk without giving away the potential returns. The emphasis here then is not on picking individual strategies, but on the collective strength and the balance of the portfolio as a whole. Each strategy in the portfolio is like a player in a football team, and they each have their own strengths and weaknesses, and it's their collective performance that determines, I guess you'd say, the outcome of the game. So as I conclude, I encourage you all to think deeply about this concept and reflect on how you can incorporate the principle of diversification across uncorrelated strategies into your own trading. And remember, trading can be as much a science as an art, and the canvas of opportunity is vast and open to innovative interpretation. And of course, mastering the Holy Grail of Investing, as Dalio calls it, doesn't guarantee an absence of losses or the promise of only gains, but it provides a structured methodical approach to navigating the precarious seas that we face in the markets world or the trading world. Ultimately, the aim is to achieve a more stable and resilient and robust portfolio that's well equipped to weather the different market conditions and maximize potential returns while keeping our risks in check. And so, having discussed Ray Dalio's Holy Grail of Investing, it's clear how vital diversification is. Dalio is one of the most successful hedge fund managers, and he argues that to strike the right balance between risk and returns, an investor should have between 10 to 20 uncorrelated returns. But how does one achieve this kind of diversification in algorithmic trading? Well, here's a plug. That's where our mentorship program comes in. So in our mentorship program, one of our core teachings is around creating and managing a portfolio of low correlated systems. Because we understand that the secret of portfolio management, and particularly in algorithmic trading, lies in the magic of these uncorrelated trading systems. So we guide people through the entire process, from creation of the strategies through the robustness tests to the portfolio assembly. We basically give you the setting files for SQX that allows you to create the same kind of systems that we use on managed funds. And we help you understand how the robustness tests work on the trading strategies, how each is designed, how each of these systems then we can end up getting designed for different market conditions. And then lastly, we look at how we can combine these strategies. And once we've built our system toolbox, then we focus on assembling all these different systems that we've created into a well-diversified portfolio. We'll teach you how to identify and measure the correlation between the different trading systems, and importantly, how to use this information to then build a portfolio that withstands the various market environments like we were talking about in the podcast. So whether you're new to algorithmic trading or an experienced trader looking to enhance your portfolio management skills, I recommend checking out TipToeHippo for more information on our mentorship program, because we provide all the tools, the techniques and insights that you need to apply Dalios principles to your trading. So remember, it's not just about having numerous trading systems, it's about having the correct low correlated systems working in harmony. And if you can achieve that, you're going to be well on your way to producing consistent, safe profits for your trading account. Until next week, I wish you green pips. Goodbye.